Will AI and the Industrial Revolution make Rockwell's future, or is it already losing the game? Is Rockwell going to be the next Tesla or the next BlackBerry? Hey everyone, welcome to the debate. We have only one goal here, to cut through all the market noise, challenge the prevailing narratives, and help you find the clearest path forward in this confusing market. Without further ado, let's get started.
Ladies and gentlemen, today I'm here to argue that Rockwell Automation, ticker ROK, is indeed a quality growth stock that deserves your attention and investment dollars. Let me start with the basics. Rockwell Automation is the world's largest pure-play industrial automation company. Think of them as the brains behind modern manufacturing. They make the smart technology that runs factories, refineries, and production lines around the globe. The company generates about $8.3 billion in annual revenue through three main business segments. Intelligent devices. That's 46% of revenue. These are the physical components, like controllers, sensors, and drives that actually control machinery. Software and control. About 27%. This is the digital brain that manages entire production systems. And lifecycle services, 28%. Ongoing support, maintenance, and consulting to keep everything running smoothly. Here's why I believe ROK is a compelling growth story. First, they're riding massive industry tailwinds. The global industrial automation market is projected to grow at over 9% annually, reaching around $560 billion by 2034. Second, look at their recent performance. Just last week, they reported Q3 2025 results that beat expectations across the board. Revenue grew 4.5% year over year to $2.14 billion, but here's the kicker. Their annual recurring revenue grew 7%. And that's over 10% of their total business now. This recurring revenue is like a subscription model. It's predictable, sticky, and insulates them from economic cycles. But here's what really sets ROK apart. They have what I call an unbreakable competitive moat built on massive switching costs. Let me explain why this matters so much. When a manufacturer builds a factory using Rockwell's Allen Bradley systems, they're not just buying equipment, they're buying into an entire integrated ecosystem. The controllers talk to the sensors talk to the software, and everything works seamlessly together. But here's the crucial part. Once you're locked in, switching to a competitor is incredibly expensive and risky. Think about it this way. Imagine trying to replace every piece of electrical wiring in your house while you're still living in it and keeping the lights on. That's what switching automation systems is like for manufacturers. The switching costs include massive retraining costs. Your entire workforce needs to learn new systems, production downtime. You literally have to shut down operations during the transition. Integration nightmares. New systems might not work with existing equipment, and risk of catastrophic failure. If something goes wrong, your entire production line stops. This creates what economists call customer lock-in, and it's ROK's secret weapon. Once customers are in the Rockwell ecosystem, they tend to stay for decades. The future trends all favor ROK. Manufacturing is moving back to North America due to supply chain concerns and tariffs. Factories need automation to compete with low-wage countries. Plus, artificial intelligence is revolutionizing manufacturing. ROK has strategic partnerships with companies like NVIDIA to lead this transformation. Their software margins are expanding beautifully, from 23.6% to 31.6% year over year. This shows they're not just a hardware company anymore, but a technology leader building the digital factory of tomorrow. ROK combines the stability of a dividend aristocrat with the growth prospects of a tech company, all while dominating a market that's essential for global competitiveness. That customer lock-in isn't going anywhere, and it's the engine that will drive its growth for the next decade. That's what I call a quality growth stock.
Ladies and gentlemen, thank you for that introduction from my opponent. But I stand here today to present the hard facts about why ROK is not a quality growth stock, and the evidence tells a very different story from what you just heard. Let me start with what quality growth actually means. A quality growth stock should deliver consistent revenue growth, expanding margins, reasonable valuations, and sustainable competitive advantages. ROK fails these basic tests. First, let's talk about ROK's actual financial performance. My opponent mentioned Q3 results, but conveniently ignored the bigger picture. In 2024, ROK's revenue dropped 8.8% to $8.26 billion from $9.06 billion the year before. That's not growth, that's decline. Net income plummeted 31% to $948 million. For the first quarter of fiscal 2025, organic sales fell 7.6%. Even their recent Q3 2025 showed only 4.5% growth, hardly the explosive growth you'd expect from a supposed quality growth stock. Second, let's address the valuation elephant in the room. ROK currently trades at a P/E of 39. That's 31% higher than its 10-year average. The PEG ratio? A staggering 3.46, more than double the industry average. In simple terms, you're paying more than 3 times what's reasonable for each dollar of growth. That's not quality investing, that's speculation. Third, my opponent talks about an unbreakable competitive moat, but that moat is leaking. While Rockwell has a strong legacy, the reality is they are in a street fight with global giants like Siemens, ABB, and Schneider Electric, and they are not winning. The competitive landscape isn't about legacy systems anymore. It's about who can innovate faster. Reports show that major competitors are aggressively chipping away at Rockwell's market leadership in North America, their home turf. This isn't a secure fortress. It's a battleground where Rockwell's position is under constant threat. My opponent talked about massive industry tailwinds, but here's what's actually happening. The Institute for Supply Management's Manufacturing Index has been below 50%, meaning contraction, since April 2025. Global industrial robot shipments declined 2.4% in 2024. Even ROK's own management doesn't expect significant order acceleration in fiscal 2025. Finally, let's examine ROK's growth prospects realistically. Wall Street forecasts revenue growth of only 5.9% annually, well below the 20% threshold for true high-growth companies. The company's debt-to-EBITDA ratio of 2 times with declining cash generation adds financial risk to an already expensive stock. Here's the bottom line. ROK might be a decent industrial company, but it's not a quality growth stock. You're paying growth stock prices for a cyclical, mature business with declining fundamentals. At current valuations, ROK represents poor risk-reward for growth investors. A true quality growth stock doesn't decline 8.8% in revenue while trading at 39 times earnings. Thank you.
Thank you. My opponent has done an excellent job of painting a picture by focusing on a very specific and, I would argue, misleading snapshot in time. It's like judging a marathon runner based on one stumble. Let's zoom out and look at the whole race, not just one difficult mile. First, let's address this narrative of declining growth. The numbers my opponent cited from 2024 reflect a temporary, industry-wide issue of customers destocking after the supply chain chaos of the pandemic. It wasn't a ROK-specific problem. It was a market normalization. The real story is the recovery. Beating analyst estimates in the recent quarter and, more importantly, growing that high-margin annual recurring revenue by 7% shows the underlying strength of the business model. This isn't a cyclical hardware company anymore. It's a software-driven leader building a predictable subscription-like revenue base. Second, the valuation. My opponent calls it expensive. I call it a premium for quality. You don't get a market leader for a bargain price. ROK's valuation is high because it has something its competitors don't: a dominant position in the high-value North American market and superior profitability. Those software margins expanding from 23% to over 31% aren't an accident. That's proof of pricing power and technological leadership that justifies the premium. You're not just buying earnings, you're buying a best-in-class asset. Now, this idea that the moat is leaking is where the argument truly falls apart. My opponent says the fight is about innovation. I couldn't agree more, and ROK is leading that charge. They aren't waiting to be disrupted. They are the disruptors, partnering with tech giants like NVIDIA to integrate AI into the factory floor. This doesn't weaken the moat, it deepens it. Every dollar they invest in AI and digital twin technology makes their ecosystem smarter, more essential, and even harder for customers to leave. Finally, let's talk about the future. My opponent points to temporary headwinds like a monthly manufacturing index. I'm pointing to irreversible, multi-decade megatrends, the reshoring of manufacturing to North America, the critical need for automation to solve labor shortages, and the digital transformation of every factory on the planet. These are the powerful tailwinds that will drive ROK's growth long after this temporary cyclical slowdown is forgotten. So, the choice is clear. You can get distracted by the short-term noise and the rear-view mirror, or you can invest in a clear leader at the forefront of a technological revolution. ROK's premium is earned, its moat is getting stronger, and its future is fundamentally sound. Thank you.
Thank you. My opponent wants you to believe this is just a temporary stumble, but let me show you why that marathon analogy actually proves my point. ROK has been stumbling for multiple miles, not just one. First, let's tackle this temporary destocking excuse. My opponent conveniently ignores that ROK's problems started long before 2024. Their intelligent devices and software and control volumes are still below 2019 levels. That's 6 years of underperformance. If this was just temporary pandemic recovery, why hasn't ROK bounced back like other industrial companies? Caterpillar, for example, has roared back to record revenues. ROK hasn't, because their problems run deeper than destocking. Second, about that premium for quality argument, let me give you some perspective. ROK trades at 39 times earnings while growing at just 5.9% annually. Compare that to Microsoft, a true quality growth company, trading at 35 times earnings but growing at 15% annually. You're literally paying more for ROK than you would for Microsoft, while getting 1/3 the growth. That's not premium pricing for quality. That's paying luxury prices for economy performance. Third, this AI partnership with NVIDIA sounds impressive, but here's the reality check. NVIDIA partners with hundreds of companies. It's not exclusive to ROK. Meanwhile, ROK's actual R&D spending as a percentage of revenue has been declining. If they're truly innovating, where's the investment? Their competitors like Siemens spend significantly more on R&D and are actually gaining market share. Actions speak louder than press releases. Finally, let's talk about that annual recurring revenue growth. 7% sounds good until you realize it's only 10% of their total business. That means 90% of ROK is still the old cyclical hardware model my opponent claims they've moved beyond. Here's the bottom line. You don't pay growth stock prices for a company that can't grow consistently, burns through cash, and relies on hope rather than results. ROK might recover someday, but at today's prices, you're betting your retirement on a maybe. Quality growth stocks don't ask you to ignore 6 years of underperformance and trust that this time is different. Thank you.
Thank you, everyone. My opponent is right about one thing: marathons have stumbles, but champions cross the finish line stronger. ROK isn't stumbling. It's sprinting ahead in a relay race, where tech meets manufacturing. Let's cut through the noise. Sure, 2019 levels pre-pandemic chaos aren't back yet, but ROK's not Caterpillar. They're not digging dirt. They're building smart factories. Their ARR growth at 7% is the future, turning lumpy hardware into steady software cash 10% now, but watch it climb as AI takes over. Valuation? Paying premium for Microsoft-like growth? Funny, because ROK's partnering with NVIDIA to AIify factories, while their R&D efficiency, not just spending, delivers expanding margins up to 31%. It's not hope. It's a moat so deep, competitors are still swimming laps behind. Bottom line, in a world reshoring factories and craving automation, ROK's the leader with predictable profits and tech edge. Don't bet against the champion, invest in it. Thank you.
Thank you, folks. My opponent calls ROK a champion sprinter, but let's be real. It's more like a runner who's tripped over its own shoelaces and is still tying them up while the race moves on. Look, joking aside, champions don't see revenues drop 8.8% or volumes stuck below 2019 levels for 6 straight years. That ARR growth? It's a nice side dish, but 90% of ROK's business is still that old, cyclical hardware feast that's leaving investors hungry. Valuation? Paying Microsoft prices for 1/3 the growth is like buying a Ferrari engine for your bicycle. Flashy, but it won't get you far. And that NVIDIA partnership? Everyone's got one. It's not a golden ticket. Bottom line, ROK's overpriced, underperforming, and betting on hope in a tough market. Don't chase this stumbling stock. Find real quality growth that actually grows. Thanks.
All right, over to you, the judges. What do you all think? I'm looking forward to seeing your votes and thoughts in the comments section. We love hearing what you have to say, and I believe every perspective brings something valuable to the table. Also, I've done my best to fact-check the information you've just heard, and you can find the relevant links in the description box below. Before you go, don't forget to hit that like button and subscribe. Your support means the world to us. We'll see you next time. Bye-bye.